Good morning, good morning, good morning, and welcome to our webinar on a world in influx needs a new investment playbook. My name is Nhlanhla Siboto. I'm the Education and Training Manager at Batseta, Council of Retirement Funds for South Africa. I am going to be your facilitator for this particular session. I hope everyone is well on this very cold. In Joburg, it is quite cold. I know we have people from around the country and everywhere else, but in Joburg, it's quite cold. I hope you're keeping well if you're in Joburg, if you are in other parts. Last week I was in Durban enjoying very nice weather. I wish I could be there again because the weather is much better than here. But we gather at a time when global markets are being reshaped by policy unpredictably and geopolitical shifts and structural reforms, from the volatility triggered by the President Trump administration evolving trade stance to the ripple effects of Wall Street's movement. I'm not sure whether the saying is still true that says when Wall Street sneezes, the world catches a cold. This morning, we woke up to news that we have just been smacked with a 30% tariff on South African goods starting on the 1st of August, with similar measures targeting 14 other countries, including Japan and South Korea. In South Africa, Regulation 28 has opened new pathways for capital into infrastructure, a signal that traditional portfolios must evolve. Today, we will explore how investors can move beyond conventional market beta and embrace alternative investments like infrastructure and hybrid capital to enhance returns, reduce risk, and build resilience. Let's unpack these strategies that will define the new era of investing, one that thrives not in spite of uncertainty, but because of how we respond to it. Today, we have a very special guest that will be giving us a presentation, Mr. Naveen Lala from Old Mutual Investments, Alternative Investment. He is a client director. Naveen is part of the OMI client markets capability, where he is responsible for institutional client relationships, capital raising, and delivering an excellent client experience across the OMI business. He has a deep understanding of both traditional and alternative investment and has served on various investment and asset allocation committees. He's passionate about investment and helping institutional investors access private market assets that have a positive impact on the economy and society. Naveen joined OMI in 2023 after having spent 8 years in the First Rank Group, where he was head of client solutions for the RMB Fund Solutions business, and prior to that, head of institutional distribution at Ashton & Burton Investments. Naveen has a master's in business administration from Wits Business School, a graduate diploma in marketing management, and is a member of the SA Institute of Stockbrokers. Welcome, Naveen. It's a mouthful there.
Yeah, morning. Thank you very much, Nhlanhla. Good to see you.
Do you still find the saying to be true that, well, when Wall Street sneezes, the world catches a cold?
Definitely. I think we've seen it on Liberation Day when Trump announced his massive widespread tariffs. I think it's becoming a case of, I think the rest of the world's catching pneumonia, never mind a cold. It's been quite wild out there.
No, we look forward to your presentation. Handing over to you.
Fantastic. So morning, everyone, and to all the Batseta members and folks on the call, and thank you, Batseta, for the opportunity to chat to you, just then share our perspectives on private markets. So in the Batseta Winter Conference a few months ago, we had a great panel discussion, which is more focused on private equity, and we had some of our portfolio companies chatting about their businesses. And I think it was very well received, where the audience was, I think, very enthused by the amount of businesses that are available in the private space and the growth opportunities in these private businesses, the growth, the scale, and looking beyond listed markets, and what's underpinned the strong outperformance in our private equity fund 5. So that was well received, and we've had lots of questions around. We understand the growth part from an equity perspective, but how do alternatives play a role in with an investment, looking at an investment objective of capital preservation or absolute returns? Were you able to participate in capital growth, compound upside returns, while not putting capital at risk? So this is precisely what our conversation today is about. It's saying, with the world in flux, we need to think about things differently, and we need to think about the new investment playbook. And as Nhlanhla mentioned, you've got the Regulation 28, which came out 2 years ago, which is encouraging pension funds to invest in private market assets, particularly private equity and infrastructure. And I'd like to chat to you about that more as we go through. So no surprise to you, the world is we're in a bit of chaos at the moment. We've just, as Nhlanhla mentioned, woken up to the news that South Africa's been slapped with a 30% tariff on all US exports, while our exports are about under 8% to the US. It's still not positive news. It's not a all fall down, but it creates a lot more stress in the system. So let's discuss, what impact this has had and what this chaos looks like. I think once we've got an understanding of that, we can get a sense of how to navigate it and structure portfolios to have just a lot more resilience in managing downside while still being able to achieve its upside potential. So if you look at the charts on these two charts, the one on the top is from the Economist Intelligence and the IMF, which measures world uncertainty. So you can see that since Mr. Trump's become president, global uncertainty's been off the charts, and global trade uncertainty has moved up quite high, and just really capturing the level of uncertainty that's out there. So I'd say that's just the magnitude of that is what we'd say radical uncertainty. And we're already seeing that starting to manifest in confidence. We can see business confidence, the chart on the left, has been softening and declining, and consumer sentiment on the right-hand side in the US has also been declining. And that's largely a response to the uncertainty that we are seeing in the policy response, not just markets. I think markets by nature are uncertain, but we're not used to seeing such a high level of uncertainty in policy. And policy impacts the real economy as well as the stock market and asset prices. So with this softening in confidence, we're seeing that on the right-hand side, the leading indicator, which has been a good predictor in terms of when the global economy or the US economy is in a growth trajectory or whether it's at risk of a slowdown. So you can already see that when there's uncertainty, both consumers hold back on their spending, and I think that's a function of lower confidence, and likewise, businesses slow down on their investment decision-making or CapEx projects, because they're looking for more certainty and want to be very responsible allocators of capital. So the indicators at the moment is that things are softening, which is a bit difficult to digest when you're seeing that the US stock market continues to make new highs, unemployment's good in the US, and the labor market is quite strong, suggesting that the US economy is still quite resilient. However, there's a lot of fear out there, and there's a lot of uncertainty around how do tariffs and Trump policy impact the economy and inflation. The chart on the left is the Michigan survey, University of Michigan survey, which it polls a cohort of folk, and it tries to find out what their sense is of inflation going forward. And the chart's got a massive spike in the last reading, the latest survey, which was end of May. And that suggests that inflation expectations are for inflation to rise as much as 7%. I think that's quite extreme. I think it's unlikely to hit that level. But the point really is that you can see that this uncertainty and this anxiety about policy direction is certainly filtering into the markets. So with that, we think about coming back to the point about growing and preserving capital in, where you've got risks in the economy, which then manifest in the stock market. How do we preserve capital? So traditionally, you've had the 60-40 portfolio, 60% equity, 40% bonds. They've worked very well, with stocks being the growth engine providing upside return and bonds being the defensive asset. And they've typically moved in opposite directions, where the success of the 60-40 portfolio has hinged on the relationship of equities and bonds being negatively correlated. So what we see now is these dislocations. So it begs the question, is amid this chaos, will these traditional portfolios like your 60-40s remain effective or resilient? And looking at some recent research, as at December 2024, we're looking at 3-year rolling correlations. And you can see there's periods when there's high correlation and there's periods where there's declining negative correlation. So in the 2018 sort of era, you can see that correlations have been negative, which meant the 60 portfolio was far more effective. However, as correlations start rising, as it has in the past 6 years, across markets, the US, Europe, Canada, Japan, Australia, etc., it demonstrates there's a declining effectiveness in the 60-40 portfolio. And if we delve a bit deeper and we're looking at why it's losing its effectiveness, it's because the stock bond correlations have been increasing across the developed markets. So if you look at France on the left-hand side, since the mid-2010s, their correlations between stocks and bonds have been rising. The same with Germany, Spain, and Italy. So if we think about the developed markets correlations rising, what does emerging markets look like? And you can have a look at South Africa, Turkey, Brazil, where the correlations have been extremely high or very high between stocks and bonds, almost 60%, suggesting that stocks and bonds, when they rally at the same time, and when there's risk off or lots of uncertainty, they both sell off and weaken at the same time, which means your portfolio is not that effective as it used to be during times of negative correlations. The reason why that is so in emerging markets is because when there's risk, all the emerging markets are hit by country risk, and country risk premiums go negative, and you'd find that affects both stocks and bonds, and it's reflected in the currency. Where the US has been the sort of perfect market, where it's had these deeply negative correlations. However, of late, over the past few years, these correlations have been rising, suggesting that, again, the 60-40 portfolio is not as effective as it used to be. And then you look at the other aspects that we have in terms of facing that these assets have to contend with, bond markets and stock markets. We've got President Trump, sort of putting pressure on the Federal Reserve and also questioning the independence of the Federal Reserve. So when there's monetary policy uncertainty, that does worry markets about whether inflation can be contained and whether there's sensible, prudent monetary policy. And you've also got this big, beautiful bill, as the Americans call it, that has just been passed into law yesterday. And that indicates that US debt or the US deficit will start to rise. And the deficit, US debt's currently at about $37 trillion odd dollars. And they've got a debt to GDP ratio in excess of, call it 130%. All of which are, I think these are big change. It's not short-term trends. These are big long-term secular issues. And that doesn't bode well for bonds, suggesting a lot more volatility in bonds, meaning a lot more risk in your defensive asset. So the asset that you thought would assist you and save your portfolio with a defensive features during market weakness, this is higher volatility in that asset means it may not provide the level of safety that you'd expect from bonds. Likewise, in the stock market, there's also uncertainty. As I mentioned, stocks have been hitting new highs. And if you look at the long-term valuations, the Schiller KP, which is about 7 years inflation-adjusted earnings, it suggests that markets by no stretch or metrics are cheap. So I'm not suggesting an all fall down. We don't know the impact of tariffs, and this could continue. But it's just things to be aware of, that there are risks embedded in markets at the moment, which are going to be there for a long time. And, we need to think about how we navigate this chaos. And I think the first steps are typically about, we've got to acknowledge the harsh truths. And I think that helps us anchor our views so that we're not solely basing our investment expectations based solely on what's happened historically. Because I think there's been massive shifts compared to what's happened in the past couple of decades in terms of policy uncertainties, unprecedented. You haven't had politics driving policy and economic uncertainty to this extent ever before. The leading indicators suggest that there are rising risks of a softening US economy with inflation expectations rising. And then, of course, you've got as I mentioned, illustrated on the correlations of stocks and bonds increasing. You've got the diminishing role of bonds being the trusted shock absorbers, or providing the safety mechanism that you've come to have trusted and expected over the prior decades. So the 60-40 portfolio, as I said, has its periods where it's worked and it's been very effective. But, the 60-40 portfolio emerged out of, Harry Markowitz's groundbreaking work on modern portfolio theory, which came out in the 1950s. So there's been lots of questions asked around it and around whether it's still relevant today. Is it dead, or is it a relic of the past? So with a lot of that rhetoric being in the market, my view, or our view, is that no, the 60-40 is not a relic of the past. 60-40 is not dead, and it just needs to evolve with the times. Just like technology has evolved with the times, so do investments. And, we've in an era where it's about active and passive and private markets or alternative investments. And Reg 28 has allowed for this new technology, a new asset class of private markets to be open for investment and to increase the limits, allowing pension funds with additional tools to manage portfolio resilience, or to build more resilient portfolios. So, in terms of navigating this chaos, there are key attributes that you'd want to incorporate in your portfolio to help weather the storm. And I think there are two aspects I'd like to chat about. The one is stable growth compounders with built-in inflation protection. And the second part is, how do you bolster the shock absorbers? How do you make your defensive aspect of your portfolio a lot more resilient to managing and enduring downside, where it provides that buoyancy for your portfolio in terms of preserving capital? So from your growth, the first one, the growth compounders, is that you want to have assets that generate stable and predictable long-term cash flows. Predictability is good. You want assets where there's inelastic demand with inflation increases, and there's a low correlation to stocks and bonds. So if you look at asset classes like infrastructure, it has precisely those features, where it has long-term predictable cash flows. The assets are long-term in nature. The tariffs and the cash flows have a long-term inflation, have contractual inflation increases. They have a low correlation to stocks and bonds, And I think most importantly is that the returns in infrastructure is based on the economic performance of the specific projects, be it a renewable energy solar plant or wind plant or a port, and they're not impacted by market sentiment. So, we always say that no matter what tariffs do, the sun will keep shining and the wind will keep blowing, and that will continue to generate power and deliver the cash flows that we require for infrastructure. We're also in this global infrastructure super cycle, where depending on whose survey you look at, there's expected to be over 80 trillion in capital spend required to keep up with demand. So at the moment, we are in a global population of about 8 billion people. Beyond 2035, it's expected to be 9 billion people. So to be able to cater for an additional billion people, you need a lot more power to power households, power for the manufacturing of goods. You need a lot more roads, logistics, water's key in, call it AI and data centers. And, as I said, ports and logistics, seaports, airports to transport people and these goods. So at the moment, there's this massive capital spend underway for the next 15 to 20 or multi-decades, in fact, to increase infrastructure. I think, looking at, has infrastructure worked as an asset class? I've just put up our Ideas Managed Fund. It's an infrastructure fund that's been going since 1999, and it's the dark green line. And you can see that it's a great demonstration of where you're able to achieve high impact as well as generating high returns. So satisfying two important criteria for institutional investors or pension funds: generating stable long-term outperformance, as well as having a positive impact in job creation and growing the economy. After all, infrastructure is the lungs of the economy, and it's important in a well-functioning society and generating economic growth. So that's the first part. It's about looking at growth compounders, where I think infrastructure is an important asset class to consider for that. The second aspect, it's about getting your portfolio a lot more robust and bolstering the shock absorbers to help bonds become a lot more defensive. And with that, you'd want to have assets that can complement and enhance your fixed income component. So typically, private debt exposure or credit has been used to diversify away from bond duration risk, and also allowed investors to have access to loans that are otherwise have historically not been available to fixed income investors. And these loans are secured where you've got security against assets for these loans, collateralized assets or cash flows, so to speak. So credit has been in great demand over the past decade. And with that great demand, if you look at this slide where you can see the orange dots, it's just showing you what the yield pickup has been on credit. So in about the 2020s, you were getting JIBAR plus 250 for credit. And there's been phenomenal demand for these assets, with demand outstripping supply. And with that, you've seen that spreads have declined and narrowed quite massively to call it JIBAR plus 125. So you're taking pretty much the same AA or AAA risk. However, your spreads have declined by 125 basis points, which suggests that even credit now is not delivering on the mandate that we'd expected to in terms of generating higher yields and fixed income enhancement. So that suggests that we need to look beyond credit for proper fixed income replacement or fixed income enhancement. And if you look at your typical 60-40 portfolio, it's invested across ordinary equity and senior debt in the form of loans, but it's been missing the middle, being called what we refer to as hybrid capital, a combination of mezzanine debt and preference shares or preferred equity. So typically, these two middle pieces, or the middle the missing middle, which we sometimes refer to, investors didn't have access to those asset classes. And that's largely because they were dominated by the banks. But post-Basel banking regulations, there's been a reallocation of capital where banks cannot hold as much of these asset classes or generate or originate as much mezzanine debt as they'd like to, because the capital charge is more punitive for them. So that's given way to an opportunity where asset managers are now filling that void. And it's still pretty niche and relatively untapped, which I think is an important opportunity or an emerging opportunity that deserves stronger consideration. So we think that, if you're looking at investing in your traditional 60-40 only, where you're looking at ordinary equity and senior debt, versus looking at the full spectrum of the infrastructure of the capital structure, it feels as if just looking at 60-40 is it's like living life out of a black and white lens, where you want to enjoy the full spectrum of color with all the nuances and attributes that other aspects of the asset class bring. So why is hybrid capital, or the missing part of the capital structure, so important? And it's because it provides important financing for companies, specifically those companies that are looking to grow their businesses and need capital to achieve their strategy of getting either acquisition or funding more growth, which drives job creation. It also it's a type of capital or funding mechanism that allows business owners to raise capital without diluting the equity control, which means they can still maintain the equity ownership while still raising capital. And the borrowing terms are flexible. It's structured in call it a symbiotic win-win relationship, where it's a bilateral agreement between the borrowers and the lenders, so that loans can be structured, or the mezzanine finance can be structured in a manner that solves for both the lender and the borrower. And I think an important thing to remember is that without this mezzanine or hybrid capital financing, businesses wouldn't be able to access financing, and that would hold back or dampen their growth potential. And it's a huge opportunity cost for business and employment growth, because employment growth happens through growth in the economy, and growth in the economy happens through growth in the business. So this this missing middle piece, as I said, has become available to asset managers and institutional investors because they were held largely by banks. And why banks are happy to bring asset managers into to play alongside them in this hybrid space is that often banks may hit their credit limits across various sectors or companies where they like the businesses, but they don't want to increase their exposure. So instead of bringing in a competitor bank to fill the financing gap, they'd rather bring in an asset manager. So we work alongside banks, but we also originate a lot of assets ourselves. And I think that's quite an important piece that we're providing in funding businesses. And for benefits for investors, you're getting exposure to a lower volatility return profile, hybrid capital's debt in nature, strong emphasis on capital protection. You've got 50% odd equity-like risk with 70% of the cash flow. So good risk-adjusted returns, and it provides good cash flow generation. The chart on the left just giving you a sense of what the performance has been. So since inception, hybrid capital has generated a return of 16.3%, and that's over the last, call it 4 years, outperforming its JIBAR plus 5% benchmark. So if you remember, credit spreads were narrowing from JIBAR plus 250 to 125, where hybrid capital is giving you well in excess of that. And the chart on the left is just demonstrating the cash flow profiles. I think that the line to focus on is really the blue line in the right-hand chart, which is showing the cumulative distributions of this strategy. And pretty much what it's saying is if you invested $100 or $110 worth of exposure, you very quickly start getting distributions back. And that's what we found an important feature for many investors, where they like alternative assets that provide yield enhancement and liquidity. And this is what we see as a liquid to semi-liquid strategy. Looking at it relative to your other asset classes, there's strong merit in terms of the risk-reward case for hybrid capital relative to the other asset classes. From a risk perspective, I've got an arrow showing the continuum of hybrid capital's risk. That's largely because they biannual. The private markets are valued biannually, so with the valuations being biannual compared to listed side where it's daily priced, you've got a lack of volatility. So we've just shown the range as the sort of implied volatility of what the strategy looks like. So I think, we've spoken about infrastructure as being this phenomenal growth compounder, and we've seen the returns of that ideas fund in generating, I think it's been CPI plus 10 since inception in 1999. We've got the shock absorbers or the bolstering of the fixed income defensive part being assets like credit and hybrid capital, which are able to bolster. So the combination of them provides you with stable growth and capital protection with yield enhancement. So if you bring this all together and you say, the 60-40 portfolio, we don't think it's a relic of the past. We think it's still relevant. And if you look at the this chart, you've got your risk on the x-axis and your returns, and it's just showing you that a 60-40 portfolio with the addition of 30% of alternatives, it reduces your risk and increases your return quite significantly. So I think from a risk-reward trade-off, it certainly requires a lot more consideration. And if you're looking at more defensive strategies like your absolute return type strategies where you'd have 40 to 50% equity exposure, the incorporation of alts is also a lot more meaningful in that. So I think with that, I'd just like to leave the audience with the sense that there's lots of opportunities out there, and your portfolio smartest move may not be in the listed space. Where on screen we've got just a few examples of the companies we've invested in while they were private, and companies that we've also funded, which are in the private debt or mezzanine space. So you'd notice some of those brands or those companies, some of them may not be familiar to you, but that's also important because it's giving you access or exposure to investments that you otherwise wouldn't have had access to. So coming back to this, this story of the uncertainty around policy and Mr. Trump, things could continue. The US economy could prove to be a lot more robust and things could be fine. Or we're still yet to see the impact of tariffs, which I think is the case, in which case there would be returns to be made, but with a lot more volatility. And I think with that, we need to look beyond beta and looking at incorporating alternative investments to our traditional portfolios to be more resilient. We've still got another 3.5 years of Mr. Trump. And I think if there's the last 6 months anything to go by, I think unpredictability is sort of the flavor of the remaining 3.5 years. And I think with that, you'd have more equity volatility, more bond volatility, and as I said, the incorporation of alternative investments would allow one to dampen that volatility while not giving up upside returns, but just having a lot more resilient portfolio. So I think with that, I'd like to stop there and just in true Trump style, thank you for your time and for listening.
Thank you very much, Mr. Naveen, for that presentation. Very much thought-provoking. Interesting picture that you used there. They say maybe as a lighter note, bonds are like your calm friend at a party while stocks are dancing on the tables. Bonds are in the corner making sure everyone gets home safe. So what you're saying is that this may be the case, but with all this volatility, it is really shifting the responsibility of the friend, if I can put it that way. Colleagues, you are able to ask questions, put them on the chat, or if you want to just raise your hands, you'll be able to raise your hands, and then we'll look at the question that you have. I know this is very much a burning issue, so yeah, you're able to do that. I would like us to really have a conversation around the presentation that we have just seen. But maybe as a starting point, Naveen, what are your thoughts on the 30% tariff we just received?
So the 30% tariff, I think, has been baked in. I think a lot of businesses since the beginning of the year in South Africa have been exploring other markets and
Mm,
finding new buyers that can absorb this.
mm,
So I think our export, these tariffs exclude commodities which are critical to the US. So it doesn't impact our mining and commodities industry, but our exports are about less than 8%
mm,
to the US. And I think that, I'll come back to the demand hasn't gone away. It's just becomes a lot more expensive for the US consumer. And I think Warren Buffett put it quite nicely when he was asked about tariffs and the impact on the economy. And his response was, it's not the tooth fairy that pays the tariffs,
yeah.
suggesting that it's the US consumer. So I think, with the looking at the way different companies and countries have responded to tariffs,
Mm,
my sense is that they've realized that the tariffs are not the end game, where it seems to be a tool for
yeah.
negotiation, where we still have the opportunity to dial these back. And we've seen Donald Trump walk back large tariffs on China, I think, when they realize the impact that it has. So I think I'd like to hope that we still have the opportunity to negotiate better terms. And I think in the listed markets, they've coined the phrase the taco trade, meaning Trump always chickens out. And that's saying that his rhetoric is worse than his bite.
Yeah.
And there is opportunity to dial these things back. So I think in markets in general, there will be opportunities. Even in bear markets, there's opportunities in areas of the market that outperform. However,
Mm,
in this level of volatility or this sort of new dispensation of the Trump administration, I think the
mm,
dispersion of returns across managers will increase
mm.
because some are going to get it right more so than the others, and some are going to get it more wrong than their peers. So I think that's why these stabilizers like private markets that are accessing the real economy and are not subject to market sentiment would fare well. I hope that answers your question.
Sure. And are we seeing a shift from policy support to actual portfolio integration with the introduction of Regulation 28?
Yes, we've seen a lot of interest in our private equity fund. You know,
Mm,
um, clients are pension funds are also they're on a journey in terms of learning more about alternative investments. and how to navigate them. And I think, while the relaxation in regs came out 2 years ago, I think we're in early days where South African pension funds have about a 4% exposure to private markets, being the likes of private equity, private debt, infrastructure. And the rest of the world is your P7 pension funds are around 25%. So South Africa's 4%, the developed world's at about 25%. However, the developed world had a 4% exposure to private markets in about 2010. So I think South Africa is a great adopter of global trends. And I think 25%, I'm not sure if we'd get to that level, but I think 4% doesn't sound like the right number. And I think with the opportunities on the JSE shrinking, South Africa having its own fiscal challenges and debt challenges, I think the bond market also has its own risks. And I think investors will start experiencing more and more, or having better and better experiences or outcomes from private markets, which will drive them to allocate more and more. But there's lots of interest in it. Infrastructure, private equity, private debt, lots of interest in that. And there are allocations underway across the industry. So I think that's very encouraging. And because it's an asset class where investors may not have as much experience, we always welcome, the discussion and questions and, an opportunity to discuss these assets, because we're very passionate about it. And we do it every day, but we also recognize that pension funds don't work this closely with it. And prior to 2023, there wasn't much reason or impetus to pay attention to it. So it's a journey, and it's a journey we'd love to partner with the industry on, in terms of growing knowledge and getting investors to better understand the benefits, features, the risks, and the application of private markets or alternative investments.
Sure. A couple of interesting questions on the Q&A. The first one coming from Rodney Shuttleworth is asking, will the 60/40 bonds ratio change on including hybrid capital? Will the 60/40 bonds ratio change on including hybrid capital?
So I think, what we've said is that what we've seen in the world is your 60/40 has moved to almost a 40/30/30 exposure,
40/30/30,
or
yeah.
50/30, whatever it is, where you've had alternatives being a combination of both growth assets, being private equity and private debt, where the mezzanine or hybrid capital fits in, taking a slug of active equity and active fixed income, or active and passive fixed income in the listed space. So I think it does complement both of them. And I think the 60/40 would give way to a third piece being private markets. We've seen happen in the developed market already. So I think we've seen more and more of that coming through. And South African investors are also exposed to quite a bit of credit already, indirectly through some of their portfolios.
But are we able to achieve capital preservation, growth, and impact without really compromising returns?
Yes, I think there's a few points to note. Is that private markets are growth in nature. So if you look at private equity investors, they're looking for companies that are growing. And we're not focusing on turnaround companies or getting companies that are just dirt cheap. We're looking at in Vine, great businesses or good businesses which we can make better, and businesses which we can grow. And that's how we make money out of it. And there's also portfolio diversification. And you've got infrastructure which has, the inflation increases in your tariffs, which provides a lot more buoyancy in the portfolio, and you're compounding these inflation increases from a yield perspective, and then you've still got capital growth on that. So I think that allows you to to have impact
Yeah.
and to achieve growth. And then on the defensive side, with private debt and hybrid capital, these strategies,
Mm.
the way we do it on our side, is that we are looking to lend money to businesses that need it for growth capital. So not businesses that are in distress, businesses that have a strong growth trajectory, that are not massively levered, so don't have high gearing, and businesses that are in quality businesses that are not in sectors that are in decline. So infrastructure is a big aspect of the hybrid capital funding because it has long-term predictable cash flows, infrastructure, and we've got this massive growth underpin where South Africa has a funding gap, infrastructure funding gap of about just shy of around 5 trillion, which is larger than the entire pension fund industry. So we can see our infrastructure around us that's creaking, and private sectors filling that void alongside with government. And we've seen that through the renewable energy program, and there's lots of other aspects where private sectors coming in. And I think that's a multi-decade theme. And to be able to lend into these type of businesses, I think allows us to do it in a very responsible way, where we also have a structuring expertise, where we take collateral, and the way we structure the deals, it provides us with a great deal of capital protection for when things go wrong. Because we're always thinking primarily, how do we preserve capital before we start thinking about how we make money out of it? And I think that is quite consistent across private equity, infrastructure, and the hybrid space in terms of how we think about things in private markets.
Another interesting one from the Q&A coming from Mr. Thomas Mketela. What is your view of Trump's threat that all BRICS members will be slapped with an additional 10%?
Yeah, that's a tough one. I think trying to predict the unpredictable Mr. Trump is a highly dangerous game to be participating in. I think it's a sure way of being wrong. But I think from what we've seen over the past 6 months, Trump likes leverage, and his bark seems to be worse than his bite. And I think he uses these large tariffs as a negotiating tool. And the US is still the largest economy with the largest consumer market, where the BRICS economies are still the US is still their largest consumer market for their goods. And I think it's too large an economy to ignore. So I think I wouldn't be surprised if he goes ahead with that, but I think it may not be the end state, where there's opportunities for bilateral negotiation to dial them back. And I think it's a lot about flexing and a negotiating tool. But
do you think
you never know.
Yeah, I never know. Do you think our regulatory framework is keeping at pace with the innovation required for portfolio design?
I think the relaxation in Reg 28 was a massive step in that direction. Relaxation in offshore allocations, in private markets, infrastructure up to 45%, private equity up to 10%, or private equity funder funds 15%. So I think it's certainly a step in the right direction, and I don't think it's prohibitive. I think as time progresses, I think we'll probably find the need that there's appetite to relax those limits or increase those limits even further.
Yeah.
Because ultimately, when we invest, we are providing funding into the economy, whether it's equity funding or debt funding. And I think funding, or they say money makes the world go round. And I think having more capital plowed into productive assets and fixed capital formation which is what infrastructure is doing, and in funding businesses to grow even further and to become bigger, stronger, more resilient businesses, helps them to become a stable employer that can absorb a lot more employment, which is positive for the labor force.
Cool. I see another question here on the Q&A. I know that Mr. Katipile is quite passionate about the US impact. He's asking, what is your view of SARB discussion of lowering inflation targets to 3%? If it happens, what will be the impact?
So I think having a stable inflation targeting across the world has been proven to be very successful and very effective. So South Africa embarked on or implemented an inflation targeting policy, I think maybe 20 years ago or longer. But it's been for a long time. And I think if you think about it, in the 1990s, the late 1990s, I think it was just before I started my career, interest rates were in the 20s. So can you imagine having an interest rate of 20%, where at the moment we're about 7.25 or whatever it is.
Yeah.
So 3 times higher than what it is. And with inflation targeting to call it the lower band of 3%, I think having inflation contained at that level allows us to have lower interest rates and a lot more stable interest rates. And I think having a lower cost of capital is very beneficial for the economy. And having stable interest rates is even more powerful because it provides certainty for businesses to plan and also for consumers to make higher purchases with some peace of mind that they're not going to have spiraling interest rates and to push them into debt and unaffordability. So I think targeting that I see as positive, and I think targeting lower inflation for everyone is good. Personally, I think we all want to see inflation be lower.
Yeah.
And I think that's positive.
100%. Colleagues, opening the floor for any questions. You can raise your hand and we'll open your mic. Any takers, colleagues? Do you see any hands on Jabulo? I might not be able to.
Nothing at the moment.
All right, I see one hand.
All right, sure. Let me open.
Dr. Herbert Danso, welcome.
Thank you very much. Can you hear me?
I can hear you loud and clear. I hope I said your name right.
Yes, that's absolutely fine. Thank you very much.
All right, sure. Go ahead.
Just want to thank the presenter for some excellent insights, and according to our research at African Investor, that certainly seems to be beginning to see. I'd be interested to have his views on is the common and often referred to artificial intelligence and its impact, but in particular not on its impact so much on the broader economy more generally. And there's some interesting research that's recently been put out that sort of shows that the asset owner community should be or are increasingly relying on artificial intelligence to inform and drive institutional asset allocation. And apparently that's really beginning to improve returns in an unprecedented way. I'd be very interested to have our presenters' views on that on the one hand, and also on the concept around investing in African green industrial infrastructure as a globally competitive investable asset class. I'd like to have his views on that, because we're always told about all of these unfair advantages that we have in the continent in terms of our, very large percentage of mineral endowment, our super abundant natural capital, which is the new currency in the world. So I'd be very interested in how he sort of is seeing that as an investable asset class and how we can potentially think about that as we look at allocation. Thank you.
Thank you, Doc. I couldn't hear much for some of what you were saying. I hope you got some of it, Naveen.
Yeah, I think if I understand the first one correctly, it was really talking about, the importance of institutions and pension funds
Yeah.
allocating to private markets and the real economy in achieving impact. And I think my response to that is that absolutely, it's critical, and we've got JSE stocks already have a large pool of investable capital from all pension funds are listed in JSE listed companies to a lot with large exposures. So I think those companies have access to funding through their equity funding through the JSE or through their banks on the debt side. And private companies are staying private for longer globally. And that's because companies want to stay under the radar, be able to have the freedom to execute on their strategies, their long-term vision and strategies, without being caught up by the short-term noise of quarterly updates and results presentations. And I think with that, it makes them a lot more decisive and a lot more, so not decisive, a lot more agile and responsive. And we've seen that in our portfolio companies, that there were companies that were listed, and the experience has been that, the likes of, call it the logistics group in our portfolio, Actum, where, the Batseta Winster conference, those CEOs spoke about just the nimbleness it gives them being private, and which has allowed them to be a lot more effective as management and to grow the businesses. So I think, coming back to that on the impact story, is that with businesses staying private for longer, there's more businesses available to invest in. And now with the Reg 28 allowing for capital to be deployed to that, it creates a sort of virtuous circle where there's more available capital to invest in these businesses, allowing these businesses to grow, allowing these businesses to offset their carbon footprint in terms of going a lot more green, and allowing them to employ more people. And with it, as these businesses grow, investors have good returns, and they're able to deploy capital back into this private market sort of economy, and so it goes. And I think these businesses have, because of their growth prospects, their opportunity to employ people is far higher than what you would typically find in I would imagine, your more mature companies that are listed on the stock exchange. So I think that impact of direct investing certainly is the way to grow an economy and grow employment. I think the second part was about Africa and the green economy.
Yeah.
So that's been well underway for decades. We've got our infrastructure business called AIM has managed the Ideas Fund, which I demonstrated on screen, which is a SADC or South African focused infrastructure strategy. But they've got the last fund which we raised was the Africa Infrastructure Fund 4. And that's been focused on themes of urbanization, being the growing population, digitization, where you can see there's a lot more consumption of data, which means it requires a lot more data centers. All of that, this digital economy in terms of AI, etc., there's a high requirement for a lot more rare earth metals, commodities, copper, etc., which is of benefit to the continent. And then you've got the just energy transition, where the African continent has a great endowment of sun and wind. And we're seeing that there's regions on the continent that are growing at far faster growth rates than South Africa. So I think that is underway. But I think it's also there's a lot more investors that can pay a lot more attention to the continent. And I think the function has been that while there's this massive growth potential in Africa and including South Africa. There's been phenomenal returns available offshore. So, if you just think about the way the S&P 500 has turned out phenomenal returns driven by the massive breakthrough in technology and AI. It's been off the charts. So I think a lot of capital has been deployed there. But I think as investors look for more diversity and different opportunities and different geographies, there'll be a rebalancing of portfolios where we're already seeing that, where investors are still heavily invested in the US, but they've been relocating capital to Europe, specifically with Europe moving out of decades of austerity into fiscal expansion or stimulus, and also looking at emerging markets. And I think investors are increasingly looking at South Africa as an emerging market rather than just as part of their Africa allocation. So I think that's very encouraging in terms of some of the trends that we're seeing.
Sure, thank you for that. Yes, I think Dr. Herbert Danso said you've covered those two questions. He put them on the chat. I see another comment on the chat from Philip Rowe saying thank you for the interesting insights and perspectives, Naveen. Hope we continue to discuss directly later. And I think that's exactly what we are looking for, that sort of engagement, colleagues, where post this you can actually engage directly with the presenter. I think we still have a little bit more time. We'll open maybe for one more hand, two more hands, and then we can close off the discussion. Is there anyone that would like to ask a question? Please let me know, Ura, if you do see a hand that is going up.
Mr. Pillay is on. You can ask him. Mr. Pillay, you can go.
Sure.
Yes, thank you. I want to talk about South African corporates and the navigation to the geopolitics and what's happening in the world. And closer to home, we saw the merger or the Sanlam investment merger and acquisitions in terms of active investments. We saw Old Mutual trying to create its own bank and all of that. The one thing that intrigues me is about our own sovereignty as South Africa. I'm not seeing enough corporate relationships with the government to say, with triple Ps, what we can do to look at our future of South Africa in stimulating the economy, creating jobs, and making it sustainable in terms of our future. What is your comment about the Investec Sanlam so-called merger, in inverted commas, if you like, and in terms of the Competitions Commission allowing that, and what is Old Mutual's view going forward? I see you'll want to open a bank and you're looking at that. But my more important point is that I don't see enough being done between corporates. I mean, you talking about the relationship with pension funds and all of that, but if you include the government and sitting around the table to say, how do we look at our future and what outcomes we must look to survive? Thanks.
Thanks, Kati. So I want to steer away from the Sanlam 91 conversation. I think, not my place to really commentate on our competitors' strategic objectives and directions. But what I can say, it looks like it's a very positive symbiotic deal for both of them, tying together Sanlam's distribution with 91's investment capability. So I think in general, there has been talk that the South African asset management industry is quite fragmented, where there's room for more consolidation. And I think that's an example of that happening. And I would imagine that there'd be a lot more of that happening in the future, with especially smaller managers being consolidated. And And I think that's across the listed market, because I think listed asset managers, in South Africa, you've had a shrinking JSE universe, which has made it tougher for them. I think they still do a very good job, but I think the opportunity set has been closing or narrowing rather. And I think also we've got some phenomenal talent across the industry in South Africa. And I think asset managers in South Africa stack up, our peers and competitors amongst the best in the world. And we've had many South African investors manage offshore assets very successfully. But lots of in pension funds has opted to rather to externalize money and go with global managers doing that. And I think that has had some implications where it's not just impacted assets under management for the asset manager, but through the value chain of, the custodian services, transacting, lending, operations, administration, etc. And I think there's some great South African managers that have offshore capability, and I think it'd be great for the industry to support them. I think on our side, we've got an international private equity fund of funds capability. It's been going for about 17 years. They've generated returns of MSCI All Country World Index by 3 to 5% net of returns. They've plowed over $1 billion of capital into international private equity. They've built a proper track record, well rated over by the international community. And, we'd like to see the South African market support, or South African institutions and asset owners support South African managers with strong global expertise and capability. Then the other part around South Africa and or government and business, I think there's a lot of examples of good public-private partnerships. I think the renewable energy one stands out very strongly as a world-class initiative and program that has been massively successful. There's a rail one, which is in its early days, which is out. So it's looking at how private sector can complement government with skills and filling the funding gap. So that's exactly what Reg 28 intended to do by increasing the regulatory limits to 45% in infrastructure, was to help crowd in capital from the private sector or private or investors in general, to be able to lessen the burden on the fiscus in terms of funding much needed infrastructure. I think, with the formation of the GNU a year ago, I think their big meetings was with business, bringing business into the fold, and I think working together in moving South Africa forward. And I think relationships between corporate and business, I think globally, there'll always be levels of tension. And I think it's a healthy tension required. But I think if you look at it with South Africa, maybe 5 years ago, 10 years ago, I think there's business was was less vocal. And I think business has become more vocal in the past couple of years. And between the collaboration of government and corporate, I think they've sort of come as they've been, the door's been open, taking them into the fold, saying it's a joint responsibility. And I think you're seeing a lot more of that happening. And I think you've got a relationship where both realize that we can't do it on our own. And to achieve our growth objectives, because South Africa's got massive potential, we need to do it together. And we've got a bloated civil service, but it's companies and business that grows the economy and that employs people. And I think we're moving in the right direction. And I think there's also lots of public-private partnerships on, things with financing government buildings or certain other government aspects, student accommodation, etc., which is done in conjunction with the with business and government. So I think there's more that can be done, is my sense that you're saying, and I agree with you. And I think my feeling is that we're on that right path and trajectory to achieve that, or to be more effective in working more closely together. I hope that answers your question.
Mr. Kati, you covered?
Yeah, thank you very much.
Thank you very much
Thanks, Bati.
thank you, Mr. Kati, for your input. I have here in my notes as the key takeaways: adaptability is critical because rigid portfolios are vulnerable in today's environment. Diversification beyond beta to offer alternative, offer differentiated return streams. Infrastructure and hybrid capital are central to future-proofing portfolios. Those are my key takeaways, but yeah, you can maybe give us your final remarks and what you would want us to take away from this presentation.
Thanks, Nhlanhla. I think you've captured it well. I think, markets are never certain. There's always uncertainty. And that's what provides the risk premium and allows us to profit out of it and generate returns for members. I think that with pension funds now having access to private markets and alternative investments, I think it's a great opportunity to access returns that were not, or opportunities that were not previously available to pension funds, because they were virtually limited to the listed market. And I think there's lots of opportunities beyond that. And I think it's both from a return and a risk perspective. And I think, we talk about diversity in teams and diversity in companies and what have you. And I think diversity is critical in portfolios as well. And I think having asset classes more than just listed stocks and bonds is critical, especially if we now have them available to us and regulation is nudging us that way. Recently you had the UK do a very similar thing as our regs, encouraging pension funds to invest in private assets so that they can boost the UK economy. So we're on the right track with that. These asset classes are available. We've got a track record of over 20 years in investing in private markets and private assets. We think it's an important asset class to consider. We think from a diversification perspective, you need passive, active in the form of listed, and you don't get more active than you do in private markets, where you're involved with businesses in driving the strategy, driving execution. We sit on the boards and we're involved with them. So I think there's lots more opportunity to do that. And I think while we are 4% in allocations and growing, I think my takeaway is chat to us, engage us. We don't want to be selling products. We want to be discussing possibilities and solutions and how we can assist pension funds on this journey to get more comfortable with this and make informed decisions. So, we've been through a 20-year learning curve, and we'd love to share that with the investment community so that this isn't seen as a complicated asset class. You've got equity and debt. It's just that on our side, it's not listed. It's unlisted, but still just equity and debt. So I think that's my takeaway. So we encourage folk to engage us, ask us lots of questions, and we want to journey together with the industry in embracing this asset class. And it's all about complementary asset classes. By no means am I saying listed equities or bonds are bad. I think they're critical asset classes. But I think, diversity is an important mantra across our strategy, across our industry. And I think we need to demonstrate that in our portfolios as well, because it's good for our portfolios from both a risk, return, and impact perspective.
Thank you very much, Mr. Naveen, Lala, Old Mutual Alternative Investment, the client director. We thank you for your presentation. Thank you for the insights that you've given. Colleagues, thank you very much for your engagement in this particular session. We do hope that you do join our next webinar. We will send out the dates aligned. Just a few quick announcements. Our recognition of prior learning qualifications are open, so you are able to then apply. When we send out the presentation, we will also send through your application. We do also have the ESG integration training that is still also open. We will also send that to you. There are a couple of opportunities from the insurance CETA. If you do look at our newsletter, you'll be able to find that there's a number of international programs that they are running there at the insurance CETA that you can be able to take advantage of. Mr. Lala, thank you very much for your presentation. We look forward to engaging with you further. Colleagues, I hope you have a wonderful day further. Enjoy the rest of your morning. Thank you.
Thanks, Chair. Thanks for being a great facilitator, and thank you so much for having us, and thanks for the great questions.
Thank you. Thank you, colleagues.
Cheers. Bye.